Good afternoon, ladies and gentlemen. Welcome to our UCITS Webinar Series. That's the second one today. Some of you may have attended the first one last week on the new regime for PRIPS kids. Today we will cover a totally different issues, meaning some specific eligibility questions for certain types of assets in the portfolio of UCITS funds. A few logistical questions before we start. If you have questions to raise to the panelists, feel free to do it by clicking on the three dots bottom in the toolbar at the bottom of your screen. And if you have some technical issues to raise your questions, feel free to chat, and you have a specific question on which you have to click to raise your hands in that respect. I will start introducing my panelists today, starting, let's say, on the left side, Fiona de Watazi, who is a consul in the investment management team of Arendt. Then we have Jasmine Cornell, who is a senior associate in the same team. And let's say we have someone not from the law firm, but from one of our affiliated companies, Arendt Regulatory Consulting, Alexandre Brajou, who is manager at the level of that entity, and that's a specialist expert in risk management. We will cover today a couple of topics like the new ESMA and CSSF FAQ. We will cover also the eligibility of certain types of bonds, and we will share with you some recent experiences we had with the CSSF, because we raised a lot of questions to them. They are always very, very, very useful, sharing their views with us, and we would like to share these positions with you to the extent that some of them may be written and known to the public, but some of them may just arise in connection of specific files and are not necessarily known from the public. And then we will conclude with some thoughts on liquidity consideration in the context of the Russian and Ukrainian crisis. Let's start maybe with the first topic, which is an update on the recent ESMA and UCITS Q&A, and I will pass the floor immediately to Fiona in that respect.
Yes. So we start with the ESMA Q&A. So a couple of questions were added at the end of last year. The first one that was of interest concerns the derogation that we have under Article 45(1) of the law of 2010, which allows your UCITS to invest up to 100% in securities issued by EU member states, their local authorities, non-EU member states, and also public international bodies to which these member states belong. The Q&A states very clearly that in order to benefit from this derogation, UCITS must invest in at least 6 of these issues, so issued by these member states and other authorities. And each issue must represent a maximum of 30%. And it's important to note this new question because up until now, we had in Luxembourg a reasonably flexible interpretation of this article in the law, where, for example, and to give a very blatant example, we would consider, for example, to have 3 different investments in US government issues of 30%, so that representing 90% of our portfolio. And then the remaining 10%, we would, for example, invest in 3 different corporate issues, so not government guaranteed issues. Obviously, these setups are now clearly no longer possible. So we advise our clients to review their portfolios to ensure that they do comply with this strict interpretation of Article 45. The second question that was included in the ESMA Q&A at the end of last year concerns a clarification which states that unrealized FX profits and losses for hedged share classes should be taken into account in calculating the counterparty risk. So that was also a clarification which was most welcome. The second point that I want to, the second Q&A that I want to mention today is the CSSF UCITS Q&A, which was also updated at the end of last year in November. The first major point,
which seems to be very easy to understand, but which is a bit more difficult to implement in practice, I have to say, Fiona. Could
exactly, absolutely. I think the rules are quite clear when we read the Q&A. However, the implementation and what we're seeing at the moment in different files is proving itself a little bit more tricky in practice. So just to remind everyone of what the Q&A states, although I'm sure you're all familiar with it by now. But the CSSF clearly states that the ancillary liquid bucket, which is foreseen under Article 41.2 of the Law of 2010, should be limited to 20% under normal conditions. The Q&A also specifies that these ancillary liquid assets should be limited to deposits at site. So we are no longer able to consider that all types of ancillary liquid assets may fall into that bucket. It is possible to go above this limit of 20% under specific market circumstances, and I will go into that a little bit more later on. What that means for our clients in practice is an update of the prospectus and an update of your portfolios if you do not comply with these limits. In terms of the update of the prospectus, the first point that needs to be updated is usually your general section, your general investment restrictions. So in order to qualify this ancillary liquid bucket, so to include the 20% limit, to also include that if you want to, that this may go beyond and up to 100% in exceptional market conditions. In this regard, comments that we're consistently receiving from the CSSF require us to qualify these exceptional market conditions, so to include examples. And the FAQ is very helpful in that sense because it includes a couple of examples, such as the collapse of Lehman Brothers, or the 9/11 terrorist attacks. And so you just have to make sure that this section now includes examples on when this limit may be breached, that it specifies that it's for a limited period of time only, and that it also specifies that it's very much under exceptional market conditions. Then you also have to look at all your investment policies. And the investment policies are drafted in a very different way, but you have to look at your ancillary, your liquid assets bucket in there, and to really specify the types of instruments that you may invest into, because they now need to be specifically foreseen in your investment policy so that you're not in breach. So if those liquid assets include, for example, deposits under 41.1, they include money market instruments, they include money market funds. These need to be specifically foreseen in your investment policy if you wish to continue investing in those. So it's really a case-by-case analysis of what your prospectus describes and what you're actually doing in practice and making sure that they reconcile.
And Alex, if I may raise a question for you or to you, any particular risk consideration to be taken into account here?
Well, from a risk perspective, the 20% limitation of investment into ancillary liquid asset like pure cash will imply for investment manager, especially from a cash management perspective, that they will have to diversify their liquidity bucket. For doing so, they will, for example, invest in other alternative liquid assets like term deposits or short-term government bond or even money market funds, supposing that proper disclosure has been made in the prospectus. By doing so, the risk of such instrument will be slightly higher than the one related to pure cash, and it is expected that those risks are properly covered always with regard to the cash management activity into the risk management framework on the investment fund manager. This is to ensure that those risks are properly monitored and it will avoid any shortage of liquidity on a very short term.
Thank you, Alex. Fabiana, let's talk about the famous SPACs right now. I hope everyone is familiar with what is a SPAC and the different phases of a SPAC. Is it eligible for UCITS or not?
So the CSSF confirmed that SPACs, special purpose acquisition companies, are eligible for UCITS so long as they fulfill the transferable securities definition, Article 2 of the Grand Ducal Regulation 2008, etc. There are a certain number of conditions that are attached to that, to the investment in SPACs. The first one is there should be an analysis that is done prior to the investment in these SPACs to consider all the risks that are attached to these instruments. The second one is that the CSSF has, in principle, limited the investment in SPACs to 10%. That is due to the overall liquidity risk of the SPACs, which obviously has to be assessed in relation to the whole portfolio of your fund. This is an in-principle limit of 10%. In terms of funds that are invested in SPACs or were invested in SPACs prior to the FAQ being published, we know that the CSSF will review these funds on a case-by-case basis. We have knowledge of funds that have, for example, an investment of up to 50%, but these are very specific circumstances where, for example, the distribution of these funds is limited to institutional investors and the overall liquidity of the fund has been assessed, and also that the manager has shown a certain expertise in managing these types of instruments. So discussions are possible on a case-by-case basis, but in principle, these investments are limited to 10%.
Thank you, Fiona. And Alex, again, I guess that there are specific risk considerations to keep in mind for investments in SPACs.
Due to the specificity of such instruments, careful consideration of the risk related to them must be given. As mentioned by Fiona, when investing in an instrument issued by SPAC, a proper risk assessment of the SPAC must be performed by taking into consideration all the specificities of the SPAC itself. By example, the risk assessment of the SPAC must cover any dilution mechanisms which may be activated by any specific shareholders following the IPO. It must also cover any clause which can limit the tradability or the liquidity of the instrument issued by the SPAC, like the shares or the warrants. And ultimately, one important thing, it's very important to make a proper assessment of the risk-reward profile of the investment and to take into consideration the potential impact on the overall risk profile of the fund, especially by considering that at the time of the investment into a SPAC, the target company is not known.
Okay, thank you, Alex. Jasmine, up to you. Very briefly, I believe we have a new rule on cover bonds. Could you please let us know whether it's a new animal or whether it does already exist, and what is the new rule?
Thank you, Michelle. So covered bonds, they do exist already. But with this directive that has been implemented in Luxembourg a couple of months ago, there will be new categories of covered bonds, and this is relevant to UCITS for a simple reason, which is that, as you know, covered bonds are eligible for UCITS pursuant to Article 43 of the 2010 law, and these covered bonds are subject to a more flexible limit per issuer of 25% instead of the 10% per issuer limit that is normally applicable to bonds. And with this directive, the interesting thing to note is that only covered bonds qualifying as high-quality European covered bonds or as European Union covered bonds will be eligible within that limit of 25%. This is therefore very relevant for UCITS, but it's only a heads up today. It will enter into force as from the 8th of July, meaning that any bonds issued as from this date will have to comply with the two definitions that I've just mentioned in order to fall within the 25% bucket. Important thing also, for the bonds that are already held in UCITS portfolios, the the directive has no impact, and this bond can continue to be held until the maturity date, and this will apply only to new issues as from the 8th of July.
Meaning also a need potentially to amend the prospectus at
Yes,
some point of time.
Exactly. Depending on the investment policy, this could also indeed have an impact on the prospectus. So 2 points here, prospectus disclosures and also the assessment from an eligibility standpoint to be updated.
Thank you, Jasmine. And let's now go through specific case studies. We have experience with the CSSF recently, and in particular, I would like to pass the floor to you, Jasmine, to talk about the eligibility of assets in an IPO.
Yes. So for that one, actually, it's Fiona who will cover.
Fiona. Floor is yours.
Fiona had the most recent exchanges, so she will have the latest update.
Yes. We've had a few questions with regards to the investment in IPOs. We therefore inquired and called the CSSF to get some additional clarifications on that. The CSSF has indicated that in principle, the investment in IPOs should be limited to 10%. It's a very similar analogy that's done with SPACs, for example, and it's to do with the potential illiquidity of these investments for a certain period of time. This limit of 10% is not an absolute limit, a hard limit. The CSSF would be willing to consider higher investment limits in IPOs, but in order to do so, it will need to consider the overall liquidity of the portfolio. So a very liquid portfolio would maybe allow you to go above this 10% limit. And also whether, for example, you have less frequent dealing frequency. So a weekly NAV might be more favorable to a higher investment in IPOs. So once again, it's a 10% indicative limit, but this could be rediscussed on a case-by-case basis, depending on your portfolio with the CSSF.
Thank you, Fiona. And I understand, of course, that the key point here is liquidity management, and that's also the reason why there are some restrictions on SPACs, which may also be part of an IPO. Alex, what's your views?
Yes, definitely. As mentioned by Fiona, it is expected that such investment in IPO remains a small part of the portfolio of UCITS fund. However, it doesn't mean that you don't have to do anything. It is very important to ensure that those investments are properly monitored and captured within your liquidity risk management framework, and especially during the phase prior to the listing, during which the security must be illiquid. In addition, a proper attention to valuation and market risk has to be made, especially because we observe generally in the market that the day following the listing on the official stock exchange, you have a high volatility of the stock. As a consequence, this high volatility may have a significant impact on the overall risk profile of the fund, and it has to be properly monitored and captured by the risk management framework of investment fund manager.
That's the major risk, I would say. Nothing else to highlight.
Yeah, nothing. Clearly, liquidity and market risk following the listing, at least during the first day of the listing.
Okay, thanks, Alex. Jasmine, up to you now to talk about securitized assets, because that's incredible. Let's say the list of questions we got from clients in that respect, and we discussed also lengthily the topic with the CSSF. Tell us a bit more about what are the current status of, let's say, the CSSF positions.
Yes, absolutely. So here we really want to give you just a global picture on the CSSF reaction when applying for a sub-funds that would invest in securitized assets. And there are 4 main points that we want to highlight today. The first thing is that the CSSF requests the receipt of a specific questionnaire. And we want to highlight it today because this questionnaire is not publicly available. So please do get in touch with us if you want to have a copy of that form. We receive it from the case officers in the context of our files, and we would be very happy to share it with you. The second thing is that this questionnaire is quite long and very detailed. And it's something that also comes up as a surprise for our clients when they are preparing the applications. It can take a lot of time to complete. It is also reviewed by the risk team at the CSSF in addition to the product team, which should also be taken into account in the overall time frame for your applications. And it also implies the filing of additional supportive documents that come on top of the responses to be given to the questionnaire. For instance, you will have to provide risk reports, risk profiles, liquidity analysis, stress test scenarios, etc. All of this, even if your ManCo is not based in Luxembourg. And that's a point on which we have had extensive discussions with our clients. So please do pay attention to these requirements. The third thing we would like to clarify is that although there is, of course, a scrutiny regarding these type of assets, the CSSF does not impose any maximum limits. So we do have UCITS sub-funds investing up to 100% of their assets in securitized assets. And that questionnaire will normally be triggered if the UCITS invests more than 20% of its assets in securitized assets. One specific point here is that when we discussed that point with the CSSF, we asked them if US agency securitized assets should be taken into account. And thankfully, the CSSF confirmed our understanding that US agency securities are not captured by this questionnaire. So if you have a UCITS sub-fund investing 20% of its asset in ABS MBS, for example, and the rest, 80% in US agency securities, they will be out of scope of the questionnaire. And finally, the fourth thing we would like to highlight today is that the CSSF, although they do not impose a limit of investments on securitized assets, they would expect some form of restriction on the marketing of the sub-fund if the sub-fund is largely exposed to securitized assets. For example, we recently filed a sub-fund of a UCITS investing 100% of its assets in CLOs, and here the CSSF was quite clear that the distribution of that sub-fund to mass retail investors should be restricted or limited, either by imposing a minimum investment amount that is quite high, for example 100K, or by including a disclosure that would limit the sub-fund to distribution only to sophisticated or well-informed investors. So that's also something on which we like to really draw the attention to our clients, because of course this would have an impact on the strategy for distributing the fund. All of this can be discussed obviously with the CSSF on a case-by-case basis, but still it's becoming a recurring request that we receive from them at this stage.
And I understand, Jasmine, that there are also some limits when there are tranches for such securitized assets.
Yes, so actually, for example, for the CLO sub-fund I just mentioned, the 100% of assets I referred to were all falling within the scope of the securitization regulation, and they were indeed tranched instruments. So that would work. But these limits in terms of distribution to retail investors, indeed, it was not negotiable. So the CSSF has a flexible approach in this regard, but it's still something that requires quite a lot of work before preparing the application. So that's why we would recommend to really anticipate that point beforehand.
And in particular, because for these securities, we have additional due diligences to be done by the ManCos, of course,
Absolutely.
which is also a major point.
Absolutely. Mm-hmm. And here I was referring globally to securitized assets, but of course, within these type of assets, you will have assets falling within the scope of the securitization regulation, which here triggers additional requirements from resulting from that regulation. And I think this is what Alex also can give us more insight on regarding, in particular, the report requirements and the due diligence requirements.
Yeah, that was my last question for you, Alex, in terms of key considerations to keep in mind for the risk management of these securities. What could you tell us?
Yeah, as it has been said by Yasmin, clearly we see that now the CSSF is focusing on the risk management of such securitized assets when UCITS is investing in. However, in addition to the proper integration of such asset into the risk management framework of an investment fund manager, the CSSF is also focusing a lot on the risk reporting side, on especially the risk reporting addressed to senior management on board of the investment fund manager on a regular basis. As a consequence, during the application of fund investing in securitization, we generally receive the request that a template of such reporting must be provided to the CSSF. In terms of contents, it is expected that such reporting are containing some details on all the securitization invested by a fund, including details on the new one which have been approved. On top of that, you have to disclose clear metrics with regard to the different risks of those instruments, like market, credit, or liquidity risk. And ultimately, you also need to provide some stress testing results based on the one you perform, both at portfolio level, but also at instrument level, meaning that you need also to disclose some results with regard to the stress testing you have to perform directly on the underlying exposure of a securitization.
Thank Thank you, Alex. Jasmine, another one for you. Are there specific considerations to keep in mind for investments in Ukrainian or Russian assets in the current context?
Yes, here we did receive quite a few questions from clients that were, of course, quite panicked with the breakthrough of the crisis in Ukraine and Russia. And we got the comfort from the CSSF that this event was considered as an event beyond the control of the manager, obviously, and that the restriction on the transferability of securities and the impact it has on the liquidity of such securities should be regarded as a passive breach. Now we move to, I would say at this stage today, we are moving towards another type of discussion with our clients on the general impact on the portfolio, how they can, of course, manage the sanction regime applicable to these securities, how they should assess it. I think we have a webinar on that topic in the next weeks to come. And we have moved towards these considerations from a liquidity perspective, from a valuation perspective as well. We had a lot of questions from clients regarding valuation. So a point to keep under the radar, obviously, until the situation improves.
Yeah, thank you, Jasmine. And another point linked to that one, of course, people and in general in the markets, our clients have been quite concerned regarding the treatment, let's say, reserved to these securities and how they could manage the liquidity thereof. We discussed, let's say, during weeks with the CSSF different ways to solve that situation. And again, I would like to highlight that they were really helpful for the market in that respect. They have issued their Q&A, of course, but before that, they were discussing with the market on a daily basis. But finally, Fiona, could you summarize what's the liquidity management tools which have been authorized by the CSSF in that specific context?
Yeah, so the CSSF issued guidance on the liquidity management tools available specifically in the context of the Russian crisis. And the CSSF distinguishes two types of funds, so funds that have a limited exposure and those that have a higher exposure to these types of illiquid assets. With regards to the funds that have a more limited exposure, the CSSF proposes the use of three different management tools, liquidity management tools. The first one being the application of fair valuation principles, and the application of haircuts where necessary. The second one that the CSSF foresees is the suspension of subscriptions. And finally, and for the first time in a very long time, I mean, we know a lot of discussions have been ongoing over the last 10 years on the possibility of creating side pockets within the UCITS. The CSSF foresees the possibility for these sub-funds to create side pockets, and Jasmine will go into more detail in just a second on those, the different ways that you may go ahead and create those side pockets. With regards to the sub-funds that have a higher exposure to illiquid assets, the CSSF would expect these funds in a first step to suspend the net asset value, the redemptions of these funds. It would also recommend the use of side pockets, and Jasmine will go into further explanations on the different ways that you may create those side pockets.
Thank you, Fiona. Yes,
but
so
could we use side pockets in UCITS? That's my main question.
That was the key question that we received. I think that's the question we received the most at the early stage of the war, and the question, of course, was actually very positively responded to by the CSSF end of March, because they confirmed that side pockets can be used for UCITS, as you now all know, I'm sure. They also confirmed a lot of flexible options actually to implement these side pockets, either by means of split of a subfund, for example, with the liquidation of the illiquid bucket or the illiquid subfund. This is a measure that is quite close to the side pocketing structuring available in France. They also allowed, surprisingly, initially, the creation of side pockets by means of a split of share classes. So you would have specific tracking shares which would be dedicated to tracking the illiquid portion of the sub-fund, and that represents, of course, the advantage that you do not have to create a separate entity, a separate sub-fund, in order to segregate your illiquid assets from the rest of the portfolio. So this is, of course, very encouraging in terms of next steps to implement these side pockets, but it's still important to highlight, as Fiona already said, that these flexibilities are allowed by the CSSF in the context of this crisis, and they should not be seen as setting up a precedent going forward. So this is really limited to the circumstances that we know in relation to Russian and Belarusian assets.
And what's the challenge, Jasmine, if we create another sub-fund to isolate these assets?
There are so many actually, and and I think that's why we received a lot of questions, but so far we haven't had any client implementing already a side pocket, because if we take the example of the new sub-fund, there is the first question of the transferability. The sanction regimes are still applicable as of today, so these assets are subject to sanctions that prevent the transferability of the title. So if you have to transfer these securities out of the sub-fund, that would create an issue. Now the CSSF came up with the proposition that you can retain those illiquid assets in the sub-fund, which is a good thing. You don't have to transfer those, but it still raises other questions. For example, we need to then create a new sub-fund that would be a clone of the existing one. How does the CSSF consider this? Will we have to go through a new sub-fund application process, or will they be more, flexible and quick in terms of time to market? I presume they will be, but this is not clarified in the FAQ. This also raises the question of the prospectus and articles of incorporation, because not all articles of UCITS provide for the split of sub-fund. So do we need to update the documentation before implementing the side pocket? That's a question which we need to address. Now there's also the question on the depository aspect of the assets. How do the depositories manage this from a risk perspective, from a segregation perspective? That's also something on which we have had a lot of discussions with our clients. And yes, what about listed funds as well, for example?
And what about sanction assets?
And what about sanctions assets? Exactly. How do we mitigate the sanction regime vis-à-vis the possibilities to segregate the assets with the side pocket? So the complexity of the structuring is actually, based on the discussions we have with the clients, there's so many points to take into account that going to the implementation stage, basically, of the side pocket requires a lot of work, a lot of considerations from a legal, accounting, operational perspective, tax perspective as well. Is this a tax event for the investors, for example? That's also a question we got. So yes, do get in touch if you have questions, because we are heavily discussing the topic. Also, you, Michelle, at Alfie level, I know that this kept you quite busy.
And do we have to inform the CSSF if we use one of these liquidity management tools in a way which is potentially a bit different than the one which is currently described in the sales documents of the fund?
Yeah, so not all sales documents specifically provide for all these possibilities. And the FAQ is quite clear on that. For example, with regards to the suspension of subscriptions or any other tools that are not specifically foreseen this, the FAQ states that the CSSF should be informed and this should be discussed with the CSSF. So it's not an absolute no-go if your sales documents don't provide for it, but it's definitely a point that you need to discuss with the CSSF. You will also need to obviously inform the CSSF if you put in place any of these measures. So even if you suspend your subscriptions, for example, you need to inform the CSSF that you have implemented this measure.
And in particular the investors, I would say.
And the investors, of course.
And Alex, from your point of view, I see intuitively a lot of risks linked to that situation. Yeah. What's your view on that?
Yes, indeed. So aside, let's say, the segregation of those liquid assets through the use of side pocketing, you still will have a huge risk with regard to the valuation of those assets. And it's very important to ensure that proper mitigation techniques are employed in order to ensure a fair value of this asset. And the most common one we have seen is the use, of course, of haircut applied on the valuation of those assets. However, following this crisis, we have also seen that it may be a bit complicated to properly assess an haircut due to the fact that in the market condition now we have a lack of counterparty, a lack of transaction, and especially a lack of liquidity. As a consequence, it's really important for each single asset to perform a proper assessment in order to ensure fair valuations And during this exercise, it may be required to use some alternative valuation methodology, as we cannot really rely on market price. On this, it has to be done under always the supervision of the governance body of the fund.
Yeah, and the key point is, of course, to ensure fair treatment of the investors,
yeah,
the ones redeeming, the ones entering, and the ones existing.
Yes, to ensure this fair treatment.
Mm-hmm. Thank you. Anything else to add, ladies, to that point?
Not from me at this
not
stage.
Really? Okay.
No, not at this stage.
Thanks a lot. I believe we are just in time, maybe for questions from the audience, and I see that we have a lot already. Feel free to raise any additional questions right now, if you didn't so far. Maybe I could pick and choose some of them. Good luck. My panelists to answer these questions. Maybe one for you, Jasmine, because we did cover it for several of our clients. What's your views on the eligibility of EU allowances? Because I understand, and that's probably the view of the audience too, because several people raised that question, are they eligible in UCITS?
Yes, it's odd to receive this question. I think there is a trend on that because, as you know, we receive it from a few clients in the past month. So EU allowances are carbon credit, basically. And as you know, I mean, we all read it in the press. It's the initiative that is booming at EU level. And of course, given the enthusiasm from a regulatory standpoint around EU allowances, the question of eligibility for UCITS has been raised. And in this regard, we have not, let's say it right away, we have not yet conducted any specific eligibility assessment that we submitted to the CSSF on the topic, but we did discuss it with them as well as with our clients. And the door is not closed, let's say, to the eligibility of these EU allowances. There's, of course, the question of qualification first, because they do not per se qualify as transferable securities. So there's that work to be performed from a qualification perspective. But we do have arguments to say that...
And from a MiFID, from a UCITS perspective.
Exactly. So the transferable security qualification from a MiFID, also from a Grand Ducal regulation perspective. We do have arguments. We conducted an assessment internally as well with the support of our ARC, with our ARC team colleagues on the topic. And the door is not closed. But we have not tested yet the CSSF views on the topic because, to the best of our knowledge, they haven't received a full eligibility assessment so far. So if you have questions on the topic as well, and if you have market opportunities in this regards, please do get in touch with us. This is a topic that we are keeping a very close eye on. And Michelle, I understand you also raised the point at ALFI level. So also keeping a close eye at a broader industry level, let's say.
Thank you, Jasmine. I hope it answered the question raised by someone in the audience. Another one, maybe Fiona, for you, are there specific requirements in terms of investments by UCITS in non-rated or high-yield securities?
So the CSSF has a particular focus on these types of securities. It has done so for a while. So whenever you have exposure to these types of securities, you may expect some additional questions from the CSSF. I think one of the main points that is under discussion and constantly under discussions with the CSSF is what happens when these securities are downgraded, when they become distressed. Because as you know, the CSSF has a 20% limit in relation to the investment in distressed securities by UCITS. And what would happen if your high yield bonds, etc., are downgraded? I think there are no fundamental issues as long as you remain within your 20% bucket. The question also, but the question is more important when you, through no fault of the investment manager, you go above your 20% limit. In those cases, you would be seen as being in passive breach. You would need to disinvest, although it may be quite tricky due to the nature of these securities, but a disinvestment would be required. And the CSSF, when you're investing in these types of securities, will usually require that your prospectus discloses what you would do if those securities are downgraded. So there are additional transparency requirements whenever you invest in these types of securities.
Thank you, Fiona. And maybe we could take a last one. There are a lot of questions on the screen. Again, we will not have time to cover every single question, but feel free. we have these questions and we will come back to you maybe separately with answer to some of the questions if they have not been covered. But I see one which might be of interest also for the audience and maybe for you, Jasmine, because we discussed that a lot in the past. Are we authorized to get exposure to crypto in UCITS funds?
I mean, of course, we are talking about indirect exposure here.
So that's the question.
So we got this publication from the CSSF, I think it was last year or a couple of months ago, maybe last year already, I believe. And yes, and the conclusion of the paper was that indirect exposure to crypto is a bit complicated for UCITS, or it's not, let's say, crystal clear, but our view would be that as of today, it is not possible to get this type of exposure for UCITS at least. However, the point is...
Even if they are sold to institutional investors?
That's the point. The point of the restriction on a case-by-case basis, of course, if you have a specific case, maybe if you have UCITS exposed to institutional investors only, that would be worth exploring the question. But my understanding is that there's no 100% clear answer on that from the CSSF. I recall that the point is being discussed still at the level of the firm, actually, and I know that you have discussions as well at the level of ALFI on the topic. So in this regard, if you have any other questions on a specific type of instrument, that would be very interesting to carry out an assessment on a case-by-case basis. But as of today, no clear authorization for indirect exposure and no clear prohibition either, I would say.
Yeah, meaning that it's clear that we cannot get exposure via derivatives because
of the lack of
the underlying,
eligibility.
of course, is not eligible. But the key question is whether we could get an exposure via a structured product like an ETC, for instance, in the same way that we do it for commodities or hedge funds, or whether we could get an exposure via indices, because we could also in UCITS get an exposure to commodity indices or other types of, let's say, uneligible indices. Meaning that there are still open questions, and as you said, we are still discussing these points at the level of ALFI, and probably these questions will be sent to the CSSF for further discussion, maybe with the industry in the near future. Thanks a lot. I will not pick up any other questions because we will exceed our time. I would like to thank all of you for having attended our webinar today. Thanks a lot for all your questions. It's a bit... next time I hope we will be able to do it physically, because that would be even more interesting to have a debate around such questions, of course, and to get the views also of the audience. I would like to remind you that that webinar was the second one of the series, but we will have a couple of others before the summer break. One next week, the 14th of June, on the UCITS cross-border distribution. Another one at the end of June, the 28th, on the UCITS delegation and oversight. And I'm sure we'll get also some questions there around the new circular on outsourcing, of course. And then after the summer break, one specifically dealing with the UCITS liquidity risk management, another one on the tax trends and the conclusion. Thanks a lot for your attention. Thanks a lot for your questions. Feel free to reach all of us if you have additional questions, and we will come back to you in respect of the questions which have not been covered today, because time did not allow us to cover each single question. Thanks a lot, and see you at the next webinar.